I'm privileged to have back on the program with me today Mr. Harry Dent. Harry is a best-selling author and is also the editor of a newsletter titled Survive and Prosper. You can obtain that newsletter for free at www.harrydent.com. And Harry, welcome back.
Nice to be back, Dennis.
Harry, I think a lot of our listeners are looking at what's going on in the stock market. The Dow recently hit an all-time high. Some of these folks have been on the sidelines, and it seems that there are some of the 401k investors jumping back in. And I'm going to talk to you about whether or not that's a good idea or not. But what on earth is going on that the Dow would reach an all-time high? It just doesn't seem to make sense.
Well, we had the real bubble occurred in tech stocks between late 94 and early 2000, and that was a bubble that was unprecedented in valuations in the U.S., more than the roaring 20s or any other bubble we've had in U.S. history. And ever since that bubble burst, the Fed and the government just simply wants to keep the bubble going. They keep lowering interest rates now to zero. They keep injecting money. We've got $1 trillion fiscal deficit currently and $1 trillion monetary injection. That's $2 trillion of stimulus a year compared to a $15 trillion economy that's only generating about $300 billion in real growth. So that's a very poor trade-off. In other words, we have an artificial recovery. In the 90s, we had very strong baby boom spending trends. We were the first major economists to project that based on demographics. We had the internet and broadband moving mainstream, just like autos and electricity and things and radios and phones and in the roaring 20s. So we had this dynamite combination in the 90s. We saw a Dow 10,000 come in a decade before anybody saw that. And then in the last decade, the baby boomers continued to increase their spending as they aged. But, from 2007 on, as we said a long time ago, the baby boomers slow down. Older people spend less, and they peak at age 46, and they drop off a cliff in spending after about 53 when everybody's kids get out of school and you don't have money to spend on. So we would be in a decline. We would be in a big debt crisis. We also saw debt, private and government together, grow from a couple trillion to almost 60 trillion between 1983 2008, growing 2.7 times as fast as the economy. Now, for 25 years, how could you do that and not expect a debt crisis? So the debt crisis started to set in. The baby boomers started to slow in 2008. We had what looked like a Great Depression and what we were expecting a Great Depression, and then governments here and around the world just stepped in and says, hey, for every dollar loss, for every bank loss, for every decline in GDP, for every decline in stock market, we're just going to put in money to make up for it. We're not going to let there be a downturn. We're not going to let stocks drop. We want to prop real estate up and get it growing again. And so this is an artificial recovery. And again, it's taking $2 trillion a year in stimulus to get $300 billion in GDP growth. That is horrible. That's a 7-to-1 ratio. Who would make that trade-off? That's how desperate governments are. So unlike the past booms we had in demographics and technologies where markets overreact, as they always do, get overly bullish when trends get too good and then crash, now we have worse, a totally artificial recovery. All this money pushed in the banking system gets reinvested in stocks, pushes up stocks. They push down interest rates so retirement investors can't get any return. 1.5% now on a 10-year Treasury bond for a no-risk return, 0 for short-term bonds. But they're doing this all to save the banks because if the banks go down, the whole system goes down. And it didn't help in Homer Simpson, and it's only helping the people who benefited from the bubble in the first place, the top, 1, 10%, and even 20% of higher income and higher net worth people. They gained the most in the bubble, and now the government's keeping the bubble going. And I see survey after survey, Dennis, that about 20% of people say, hey, the economy's better than ever, and about 80% say we never got out of the Great Recession. We never recovered. That's the difference between the people who have high net worths and are benefiting from the bubble and the people who are still underwater in their homes and are watching their real wages decline and unemployment still threatening.
Harry, I'm listening to you talk, and I think our average listener out there is saying, well, wait a minute, we're spending $7 to get $1 worth of growth. That is lunacy. That's probably even a nice way to define it. that can't continue. So what is your outlook for the stock market moving ahead and why? And we've got about 3 minutes left in this segment.
Well, we're seeing around the world, and especially in the United States, a number of patterns. We call them megaphone patterns, where each bubble has taken us to new high in major indices, and then each crash has taken us to new lows. So the S&P is just at that or a little higher right now. This is an important point around 1,600. The Dow hits it higher around 16,000 this summer at this rate. So I think at this point, markets look like these bubbles just go and go and go, and they do want to suck everybody in. I think markets probably have 6-7% higher to go on the upside, but when they finally crash faster or quicker, they've got 60% plus on the downside. So it's not a good time to be rushing in the markets. And if you do, let them go up a little higher, but you better start pulling out later this year.
Well, Harry, in the couple of minutes we have left, moving ahead, are there any businesses or any sectors in the economy that you expect will do well?
Well, healthcare is more recession resistance. It's now 18% of our GDP, and it's the one large sector that is going to still grow dramatically with aging baby boom demographics. Houses peak earlier on the spending curve around 42, so that peaked first. Automobiles peak the latest around age 53, so that's still maybe a year or so ahead before it drops off. But there aren't many things that grow after age 54 for American households, but healthcare is one of them. So medical devices, pharmaceuticals, biotech are probably going to be some very good sectors even in the downturn. And then every time there's a crash, we want to buy the emerging countries that have the least dependence on commodity exports, because we see a 30-year commodity cycle having already peaked, and that's going to hurt emerging countries for the next several years. But you got Mexico, Turkey, India, Southeast Asia, a lot of countries that don't depend on so much on commodity exports, but export more manufacturing goods, and they should do well. But you got to wait for these crashes first, because when stocks crash, just like in 2008, everything goes down: stocks, commodities, real estate, and all sectors of stocks. So you really need to buy the best sectors after we see the next crash, and we just say we're closer to a top now, and you got to wait and have the guts to buy if we see another crash in the next few years.
Well, if you're just joining us, we are chatting with Harry Dent, best-selling author and also the editor of a newsletter, Survive and Prosper. You can get more information on that newsletter as well as get it for free at harrydent.com. We'll continue our conversation with Mr. Dent in the next segment. Stay with us.